Okay, I'd like to welcome everybody to this session. Thank you for attending. We look forward to your comments and questions. We've assembled a really great, top-notch international group of panelists to discuss different aspects of catastrophe modeling and how really to move risk modeling beyond insurance and to use it to analyze the catastrophe exposure of the state. So we've got 6 great presenters, the first of which is going to be Nikhil Da Victoria Lobo from Swiss Re. Nikhil has worked a lot in risk transfer projects, transferring risk from the public sector to the private sector. He's going to share some of his observations and experiences, and I'm sure it's going to be a great presentation. So without further ado, please welcome Nikhil.
I'll start off just because I know there are a lot more qualified people than me coming afterwards, so I want to make sure I use up only my 10 minutes. It is 10 minutes, right? I should have said 20. Thank you, everyone. Again, I guess as the first person, you're going to hear a lot of really, I think, interesting ideas today about the concept of slightly a bigger picture. What's the exposure of the state? What's beyond insurance? And the people you're going to hear from today are really, in my view, the experts in this field from both the public and the private sector. And so I'd really like to think of my presentation only as an appetizer for what you're going to hear from them. I often start with this slide. I'll stay near the mic. I often start with this slide about natural catastrophes. And particularly when I'm in the United States, I do make the comment that we do see an accelerating trend in natural catastrophes in frequency, but also in severity. There could be debates on whether it's due to climate change or not, but leaving aside that contentious issue, at least here in the US, certainly at a minimum, as more and more people and more values are being located closer to exposed areas on the coasts, even in earthquake zones, we see an increasing trend of economic losses. And I think that's probably self-evident to many people here, especially those from catastrophe-exposed areas. What's probably one of the more troubling aspects to me is that while we see a similar increasing trend in insurance losses, it's not catching up. So when we look at this 30-year horizon, insurance is still contributing, and I'm happy to bear the blame for my industry for that partly. Insurance is not contributing as much as it could or it should or what we'd want it to. So really the question is, how do we bring new measures to address this gap, what some people call the economic loss gap? That said, I also want to take this opportunity to highlight, particularly being here in Washington with representatives from some of the industrialized countries, to also highlight that this is not an emerging markets issue. And I'm glad the World Bank is hosting this, but we need to emphasize that it's not just middle income or lower income countries that are exposed. One of the top scenarios that we view for natural catastrophes is Japan, actually. And I've highlighted here Mexico as well, and you'll be hearing from some of our friends at Hacienda later, Hacienda in Mexico. But here I also highlighted the situation of Japan. Now, to put this number into context, 500 billion, the financial crisis in the initial 12 months cost $648 billion. So over 12 months, that was kind of the aggregate value that was eroded. Obviously, it accelerated over time. Hurricane Katrina in 2005, over essentially 3 to 5 days, cost $160 billion of economic loss, of which only 40% was insured. So imagine putting into context a major earthquake in Japan, which within a matter of seconds or minutes at most, is going to eradicate $500 billion, create an economic loss of $500 billion. We're talking about a major market-moving exogenous shock event to the global economy. So again, I want to highlight this is not just an emerging markets issue. We need to collaboratively push for more solutions across the spectrum. I think this topic also, though, raises the question of what is insurable. if we're talking about economies like Japan, which have better mitigation and risk assessment, which have higher insurance penetration, if we're still talking about only a fraction of the losses being covered by insurance, where is the rest of the risk going? And the first thing I want to highlight here, particularly given the theme of today and the next few days, is also coming from an insurance background. Clearly, prevention and mitigation are central issues, and we need to put attention towards mitigating and preventing as much damage as we can. That said, as the cases I think of Haiti and Chile show, there's always residual risk. Haiti had unfortunately very poor construction standards and had a very nasty event. But Chile, which had some of the best construction standards in the world, had an equally devastating event that cost the country $30 billion. Prevention and mitigation go only so far. We need to think beyond prevention and mitigation, and to what exactly is constituting those economic losses. Here I offer three ideas, but there's more to it. There's clearly emergency relief expenses, which are often incurred within the first, let's say, 4 to 6 weeks following disaster. There's reconstruction, which is an 18-month, sometimes up to 3-year process. But then people pay very little attention to is the lost economic production and taxes. I happened to be in New Orleans 2 weeks ago, and when you're in the French Quarter, it seems as if life has returned to normal. But 2 blocks outside of the French Quarter, and you forget that nearly 5 years have gone since Hurricane Katrina. Major disasters create major changes in economic structures, and we need to find a way to address these issues. I'm just going to cover this very quickly. When we talk about typical disasters, emerging markets or industrialized countries, the immediate response is, well, if you're an industrialized country, maybe the federal government will pitch in. In emerging markets, we talk about things like donor aid. We talk about things like reallocating budgets, or even fiscal measures. Chile is introducing new taxes. They're going to be tapping into their sovereign wealth fund. These are clearly fiscal solutions to a disaster issue. I'd like to propose an alternative, and I'm hoping that, and I'm sure that the speakers after me will give you a little more background to this, and that's of pre-financing disasters, trying to address the financing before the disasters occur. The first thing I'm going to very generally touch on, some of you may already know this, is the World Bank put together a very innovative solution last October. We were happy to have collaborated with them on it, as AIR was also involved. And the idea here was essentially a capital markets instrument to help transfer the economic loss away from a country to the capital markets. And as our colleagues from Mexico will comment, this is not only an effective way to do so, but importantly, it's not a debt instrument. We're finding a way to transfer risk without really hitting those debt ceilings that are such a pressing issue, even now, 6 months, 12 months after the worst portions of the financial crisis. Another alternative that's been proposed, similar in concept to some of the work that's being done at the World Bank, is the IADB's Integrated Disaster Risk Framework. Here it's interesting, I thought, because they brought together linking various instruments, including an insurance module, that really put the burden on prevention, but found a way to use various instruments to transfer risk as you get to the more less frequent, more severe events. And also did it in a way that has a parametric component to it. I think that this also brings into the question, which I often raise to people, we've talked a lot about data quality and making things insurable. I think that's a great idea, but we also have to recognize that, again, sometimes insurance is not the best solution, and there are other instruments out there that can serve equally as well, if not better, purposes. Alternatively, there are times when providing contingent debt financing is not the best solution, and we can more economically transfer it through insurance, or potentially even retain it. The third one I'd like to highlight is, just so we know that we think about concepts beyond just pure catastrophe risk, is what the World Bank is doing in the agricultural sector. Again, similar philosophy, finding ways to transfer the government's risk, essentially what's borne by the public sector, to the private sector's shoulders. In this case, they're really looking at an agricultural exposure. What happens when you have climatic or weather events that put a burden on agricultural production, and therefore we need to find a way to essentially cover that for the government. in conclusion, I've been in this business a couple of years, and I have to say that I increasingly grow more optimistic. I was mentioning to Olivier just before I started here, I did a timeline the other day for a presentation in Cancun with Mexico, putting together these transactions. The first one was done by Mexico in 2006, CatMex. And as I was putting this slide together, and maybe I should have brought it, I was surprised at how many more countries are trying to come to the market with these solutions. It's really an accelerating trend. The challenge we have is that Mother Nature is not as patient as maybe we politically have got used to. Which brings us to the last point. We can actually collaborate to find a way to transfer this risk, to prevent and mitigate what's necessary, but also to mix the instruments in the right proportions. And I look forward to the question and answer session, to the discussion over the rest of the day, to really think about how we can bring these public-private partnerships together. Thank you.
Well, thank you, Nikhil. I think you raised a lot of relevant issues that will be expanded upon and certainly be touchstones of the presentations that are to follow. It's very interesting that you raise, you sort of close with the concept of risk transfer and transferring risk from the public sector to, whether they be investors in the capital markets or participants in the reinsurance space who are willing to absorb some of that risk. And I think maybe a question worth bearing in mind is, how much of the risk can be transferred? Some of the risk is, at the end of the day, is going to have to be retained. And how do you strike a balance? And our next speaker, Jose Angel Villalobos, is going to talk about what's going on today in Costa Rica and touch on some of those themes. Sorry? Yeah, all right. Sorry. I'm being reminded to make the announcement that as far as if you're wondering what we're going to do for questions and discussion, if you would please make a note of your questions and write them down and then pass them to looking around for an usher who will collect your questions. If no usher appears, I guarantee I will personally walk around and collect everyone's question. And at the conclusion of the sessions, all of our panelists will sit here and we'll engage in a more collaborative discussion. So if you could please write your questions down, and we will take them at the end of the session. So I'd like to ask Jose Angel to come up. We'll see if we can bring up his presentation. Oh, that's fantastic. Appreciate it.
If you have questions,
Okay.
So good afternoon to everyone. The name of the presentation maybe is a little strong. It's about we are trying to ensure the economy, but for a risk management point of view. And that is the idea. All the products and services of the economy, at least in Costa Rica, flows through all the public facilities, the public buildings, the roads, the bridges, and so on. That is the idea. This is basically the steps, as we understand in the insurance industry, the risk management process. We are trying to identify and analyze the loss exposures. We then examine the alternative risk management techniques. Then we select the best risk management technique, and then we are going to implement and monitor the selection. When we try to analyze the loss exposure, we divide the different causes of loss, maybe catastrophic or no catastrophic. What are the items exposed to loss? Real property, personal property, so on. The consequences of the loss, maybe the loss of the value of the building, also the consequential losses, for example. We want to identify the loss exposure. Normally, or usually, we use a questionnaire with flow charts or financial statements. And finally, we made an analysis of frequency and severity. That is where the part of CAPRA make a lot of sense. CAPRA, or in general, the modeling, maybe stochastic or deterministic. And that is when the support of CAPRA and Integral, which is another provider of stochastic modeling, catastrophe stochastic modeling. That is in theory. In the practice, what happened, at least in the case of Costa Rica, and I understand that is the case of many governments, not just the case of the third world governments, is the universe of the real property is unknown. There is not a proper inventory of all the different buildings and schools and roads and bridges and so on. That simply don't exist. This is the database. So there is a absolutely need to have that inventory. Also, the government, the Minister of Finance, is usually not conscient about the contingent liability that the state has, but because they don't have transferred the risk to a third party or consciously retained, at least consciously retained, maybe it's no. So I work for the INS, this is Instituto Nacional de Seguros, it's a state-owned company. It has about more than 85 years old company. As such, we have currently a part of the real property of the state insured, but this is just a part. And then we use such information as a proxy, and with the help, with the support of the experience of the World Bank, to make some conclusion and to try to establish some way, a vehicle in order to transfer such liabilities. So that is, we think that it's better to have a coverage, maybe with no perfect information or perfect basis, but this is important to have the coverage. Also, in Costa Rica we have a law for everything. Believe me, for everything. So there is also a duty for the administrators of the public building to ensure or to have some kind of protection for the buildings. Okay, that is the reality. Okay, after that we want to analyze the loss exposure. Maybe somebody, or many of yours are hear about the triangular hemorrhage. It was a study made by the Englishman many years ago. It was about the workers' compensation claims, in which it was a triangle. The base of the triangle is made of high frequency, low severity claims or losses. Then it's a secondary claim layer, and then the third layer is high severity losses with a very small frequency. That is what I want to study. That is the kind of catastrophe hazard that we want to study. It's quite difficult, and it's not possible to use the normal modeling using a parametric distribution, trying to fit and use a chi-square test to see and etc. It is absolutely necessary to model and to use simulation in order to have some results, and even the results are quite uncertain. As an actuary, is not the same. I don't have the same. I'm not have the same level of confidence about, for example, a premium rate which I made for a life assurance, for example, based on a mortality table, than a rate made on a catastrophe coverage, for example, earthquake. It's quite different. In the case of our country, we have basically almost all the hazard. Even in a ranking of the World Bank, I think that it is the second or third country, because we have earthquake, landslide, flood, volcanism, hydro, meteorological hazard, tsunami, of course, because it's of the earthquakes and so on. So it is in our case, it's just a matter of time, but it's almost certain, like that we are going to suffer a catastrophe in some moment. And the problem is increasing because Costa Rica is quite small. So a real catastrophe is going to affect the whole country. It means the capacity of the public government and the private also. It's not the same, for example, if an earthquake happens in Mexico. It affects a part of the country, but it's improbable that affects the whole country. This is a problem of countries like Costa Rica or the Central American countries in general. We are quite small. And again, CAPRA provide us a multi-hazard model with local knowledge. In the case of earthquake, there is another project because it's finished and it's done, which is called RESIS 2. I think that it was promoted by the the government of Norway and Spain and a lot of many other public and private business. And these persons, the local seismologists, work together in all the region and have a very nice seismic catalog. And this information is fit CAPRA. And this information is public. Everyone can study it. So that is quite important, because this is putting all the companies, the governments, insurance companies, the governments, with a glass box in order to discuss this kind of stuff technically with the reinsurance or the capital providers or whatever. So this is quite important. In the case of Costa Rica, earthquake is our major concern from all the parties, at least for this analysis. So we concentrate in this period. And at the INS, we have been using earthquake models since 1978. Of course, deterministic in stages, and now we use a stochastic approach. We use for the construction both CAPRA and use Integral, which is another modeling Colombian company, models and the software. We have finished a first phase which incorporated public buildings and social houses. And as a second phase, we are going to integrate roads and bridges, and then at least has a big part of our economy insured. This is an example of the distribution in the 7 provinces of Costa Rica. San Jose is the capital, is the most important, also almost 50%. And this is the usual results that we have in the modeling, in the catastrophe modeling result, which is a PML, a pure premium, with this expected amount of losses. And more important, we also have the premiums, the rates, divided by section, by the lowest administrative division, which is the districts. Okay, finally, when we're trying to make it a risk management exercise, we are going to use all the risk control techniques. Exposure avoidance, for example, it don't make sense to build houses in a zone that you know that is prone to earthquakes. It's the fault, and of course, loss prevention and reduction. We're trying to reduce the frequency and severity, and then finally, you look for the risk financing techniques. Maybe retention, maybe transfer by insurance or no insurance. Quite probably a combination. It makes financial sense and is sustainable in the long term. So,
1 minute to wrap up.
Okay, thank you. This is the the scheme that we found for catastrophe risk transfer vehicle, the CRTV. We are using a trust, which will be created by law. We are going to have some reserve that the insurance company is going to put. This also accessible for private insurance company. It's open, of course. We are using maybe a KDDO with a government cost risk guarantee, then reinsurance. Of course, this is related to the graphic that representing the same with this con respect to the probability. It makes sense, financial sense about the cost of everyone. And this vehicle, we found that this is a cost effective for the government to transfer the exposure and try to have the money for reconstruct and rebuild. We are now in this step now. We are in the implementation. The idea is we are now currently making the analysis to incorporate the roads and bridges into the CRTV. And we have the draft for the law, and we are now promoting the passing of the law in our parliament. Most important, this is quite important, the research. The research must continue at both the academic and the industry sphere. It is quite important. The academy have to work hand with hand with the insurance and the financial industry. That is because the catastrophe model results are quite uncertain. For more perfect or state of the art, they are quite uncertain. So there is necessary more research. And that's it. Thank you.
Okay. Thank you, Jose Angel. I thought that was a very interesting presentation, particularly with regards to the issue of identifying in Costa Rica, at least, what is the exposure of the state, and the comment that was made about, maybe it's better to at least start an imperfect solution without a detailed list of what is the exposure, rather than wait until you have a comprehensive database of exposure of the state. There were a lot of other points that I'd like to talk about, but I'll keep things moving. But if anyone is more interested, I would strongly suggest you go onto the session website. Jose Angel has written a nice description of the situation in Costa Rica, and I think you would find that interesting. Right now, I'd like to welcome Olivier Maul. Olivier has experience working in a number of countries on many issues, most of which are related to the themes of this session. So I'll turn it over to Olivier.
Wonderful. Thank you, Stuart. Good afternoon. A lot of things have already been said, both from the reinsurance industry and some very interesting example in Costa Rica. The purpose of my very short presentation is mainly to discuss with you how the World Bank has been trying to use this kind of risk modeling techniques in our dialogue with Ministry of Finance. As you know, the World Bank has been and is currently involved in many kind of operations related to disaster risk financing. And our main counterparts are always sovereign agencies and of course mainly governments. And when we talk with Minister of Finance, you have to find the right way to talk about them about disaster risk financing and disaster risk management. First of all, this is a kind of framework most of you are very familiar with, going from risk identification to post-disaster risk construction. I will not go through that. The point I would like to mention is that usually when we do, first of all, disaster risk financing is a small part of the overall disaster risk management. And we are very conscious about that, and usually this is not the first thing you want to promote. There are many things to be done and to discuss with government before we move into disaster risk financing. And practically the way we operate is that there is an ongoing dialogue on disaster risk management, and when we think that the governments are mature enough to talk about this kind of sophisticated tools, then we can engage a dialogue. But this is definitely not the first thing you're going to talk about a country when it comes to manage their risks. The second message I would like to convey from this slide is that for most of these kind of pillars, A, B, C, I would say A, B, D, and E, your main counterpart is not Ministry of Finance. You're going to talk with the disaster management offices, you're going to talk with the Ministry of Interior, you do not talk with Ministry of Finance. What is nice with disaster risk financing is that this is a way to engage with the Minister of Finance. And we all know that at the end of the day, Minister of Finance will have to make decisions in terms of allocating funds, even if they want to rebuild buildings, or if they want to retrofit buildings, or invest in disaster risk reduction. So you have to have a dialogue with the Minister of Finance. And sometimes the kind of tools or language you're going to use with the disaster management officers, meaning engineers, are not the same kind of language you're going to use with the Ministry of Finance. So again, disaster risk financing is a nice way to introduce and to put around the table the Ministries of Finance and to start this kind of dialogue. Now, when we talk about disaster or financial protection in a broad sense, I would say sovereign risk financing, which is in fact the financial protection of the states. There are many tools. I will not talk about the tools here. I don't think it's the purpose of this session, but mainly about how we can use these modeling tools, again, to engage the discussion. However, I like to emphasize one very critical point when it comes to develop some products. Of course, you're going to use some modeling techniques, but then all the dialogue about budget appropriation, all the dialogue about budget execution is a critical point. For example, in the country I just came from, they want to develop an insurance scheme to protect some of their public assets. And the way it works under the insurance law is that any payout, non-tax revenue, has to go through the fiscal department. So you could imagine a system where the National Disaster Agency wants to buy insurance, which is fair if they want to have quick liquidity after disaster. But because of the law, the money will have first to go through the Ministry of Finance and then go back to them. So you're going to lose time. So this is a perfect example that if you don't match the tools with the proper budget appropriation, you're going to lose some of the benefits of the tools. Now, having said that, if we now zoom on the disaster risk financing pillar, which is again one of the 5 pillars, here is more or less the kind of framework the World Bank has been using for some time. Again, it's an evolving framework. It's based on our interaction with our clients, like Costa Rica, like Colombia, and many other countries, and an interaction with the private sector. What we're trying to do here as the World Bank is really to work as a kind of convening power, a facilitator, and to bring expertise, experience, and technical assistance to our countries. So, in terms of the 3-pillar model, and again, I will focus most on the first one, which is assessing catastrophe risk. Now, what do we mean by assessing catastrophe risk? Is it to produce some hazard maps, which can be very useful for urban planners, but not very useful for the Ministry of Finance? Are we talking about economic losses? Very important, but then it's not exactly what the Ministry of Finance want to know. They want to know the fiscal impact, which is not the economic impact. And then goes back to the notion of contingent liability. What is the responsibility of the government in case of a disaster? Social responsibility, contractual responsibility, and political responsibility. And usually, in most of the cases, the law does not explicitly say what is under the responsibility of the government. We know de facto that if there is a big disaster, although the government may not have the obligation to help poor people, they will do that anyway, because it's a kind of social contract they have with the population, although it's not mentioned in the law. So what is very important when you start, even before using some modeling tools, you need to sit with the government of finance and to clearly identify their contingent liability. Again, some of the assets are clear. Public assets are owned by the government and have to be rebuilt by governments. Now, in terms of social assets, some of them, again, will have to be rebuilt by government, or some financial assistance will have to be provided by government, but again, it's not always explicitly clear, so you have to clarify that. And then once you've done that, then you can move into a kind of fiscal impact of natural disasters. Then you can go to Minister of Finance and to say, look, if you have a major disaster, here is your impact on your budget, in terms of short-term needs and long-term needs, in terms of revenue impact, and in terms of additional expenses created by the loss. Once you let's say, sensitize the government, and it's a long-term exercise anyway. Once you sensitize, then you can start talking about solutions. And there are, in fact, 2 sets of solutions. One is to say, why don't you try to promote the private sector? And Nikhil was saying that even in developed countries right now, the role of the insurance industry to capture, at least to retain, some of the disasters, some of the losses caused by natural disasters are quite limited, which is even more true, of course, in developing countries. So by deepening the private insurance industry, you can help the market to propose solutions to some of the households, maybe not the poor household, but at least middle-income and low-income households, high-income households, and then this risk will be transferred to the private sector, meaning that if there is a disaster, there will be less social pressure for the government to intervene for this specific class of the population. And then the money which is available will be then devoted mainly to low-income people. And we have plenty of examples where after disaster, because the law is not clear, there are some social pressure coming from middle-income and high-income households asking for funds. They get the funds, but then, of course, very little is left for the low-income people which don't have this kind of social power when it comes to bargain with governments. And then, of course, you can talk about agriculture insurance, and Nikhil mentioned an example, and also, again, the property insurance of public assets. And again, the work that is being done by INS in Costa Rica is a wonderful example, not only for Costa Rica, but can be definitely replicated with some adjustments, of course, in many other countries, how you can promote public assets. And again, on that, a couple of points. It's not only the issue of finding capacity in the case of disaster, but it's also a nice tool to promote transparency and discipline in your system. Once you know what are your risks, then you can have a kind of proper system in place, and insurance brings you discipline and transparency. Transparency in the sense that the premium will reflect the risk. And then again, the Ministry of Finance will be aware of the risk they face. If they have to pay a premium, then they may say, well, instead of paying a premium, I may also want to retrofit my buildings, again, and then to engage this kind of discussion in risk mitigation. And then finally, and I'm going to focus a little bit more on that, the third pillar is, the third component, the third pillar is about sovereign risk financing. Some of the risks cannot be transferred, and they may have an impact on your budget. So it goes back the notion of budget support. In the case of a disaster, how the government can just secure some funds to cover their emergency needs, recovery losses, and recovery costs. Which brings me to this next slide, which is how can we match the funding needs? And again, going back to the risk modeling tools, most of the tools developed by the risk modelers are mainly for the insurance industry. And the insurance industry has to pay tomorrow the total loss they faced. The problem for government is completely different, because the time frame is different. In the short term, they're going to face some relief needs. It's a quick injection of cash, but limited injection. While in the long run, of course, they're going to have this kind of reconstruction phase, where most of the needs, financial needs, will be affected. But still, this is not something you're going to start tomorrow. So when we think about the modeling tools, and we've been working with our partners here on some of the projects, is to make sure that when we model losses and when we estimate losses, we can decompose the losses between short-term needs for governments, medium-term needs, and long-term needs. And again, these kind of tools are very relevant for the Ministry of Finance, a little bit less for the private sector. So this is where, in fact, the tools have to be adjusted, have to be adapted to the clients and to the applications. Which in fact brings me to the slide, to the same slide, the graph we have on the bottom, on the top, which again shows you that for each of these kind of three basic phases, in a post-disaster phases, relief phase, recovery phase, and reconstruction phase, you're going to have different products. In the short term, you want to have access to quick liquidity to finance your budget support, to finance your emergent needs, and to some extent to start your early recovery phase. And you have some tools for that. Insurance is one of them. Contingency funding could be one. We could also have some reserve funds and some more, let's say, more sophisticated products like catastrophe bonds. Again, these kind of products are very expensive to finance, so you have to be very careful on when you want to use that. And then, of course, you're going to complement that with some post-disaster financing, where you're going to have time to mobilize funds either from donors or from international agencies or from banks. You're going to get some post-disaster loans, and then you can start your reconstruction activities. Here's an example where, in fact, we are doing some risk modeling work in the Pacific. Again, this is a region where the market by itself will not go, because the business is clear, uncertain, and very small. So we are working with 16 small Pacific islands, and we are developing for each of them a catastrophe risk model. So again, this will be a tool to educate the Ministry of Finance and potentially to lead to some financial instruments. And one of the key issues already highlighted by José Aurel in his presentation is the need to collect exposure data. Where are the assets at risk? And you can imagine in a region like the Pacific, this kind of information is not always available, so there is a big very important work being done in partnership with the Asian Development Bank, to develop for the first time in the region a regional database, which can be used not only for insurance purpose, also can be used for planning purpose. So again, this is an example where this kind of modeling tools can be used for many types of applications.
Olivier, 1 minute.
I will just talk quickly about risk financing in Vietnam. Just again, not to go into details, but just to show you this kind of dialogue we're going to have with governments, where again we can use some risk modeling tools to sensitize the governments about some potential funding gap after disaster, and then to help them to identify these gaps and potentially to come and to propose some solutions. Conclusion in 30 seconds. Ministry of Finance usually is not involved in the dialogue on disaster risk management, and risk financing is a nice opportunity to engage them in disaster risk management through disaster risk financing. The tools we have right now are mainly tailored to insurance applications. What we're trying to do now is to tweak them a bit in order to adapt them in the context of the fiscal impact, again to respond to the needs for of the Ministry of Finance. Very last point, again, some very concrete application we've been doing in some countries is to use these risk modeling tools to help insurance regulators to better supervise the insurance industry. Going back to the initial point, it's a good intention to want to develop or to deepen the insurance market, but if you allow the insurance companies to underwrite catastrophe risks with all the kind of risk attached to that in terms of major losses, you want to make sure that the insurance supervisor will have the right tools to monitor them in terms of capital requirements, in terms of supervision, and in terms of access to reinsurance. So again, these are very concrete examples where we've been able to use the risk modeling tools to respond quickly and hopefully efficiently to the needs of Ministry of Finance and other ministries in developing countries. And I will stop here. Thank you.
Thank you, Olivier. I think I would need 10 minutes to summarize all those points because they were very interesting. At least two stuck out to me. Was one, being from the private sector, sometimes we have the perception of thinking that the state is the state, and the state is not always a uniform body. It's made up of many different diverse interests, and well, that's one of the takeaways I got from your presentation. And related to that is backing up a minute. Even if you have the most advanced model in the world, what Olivier did, I thought, was very nicely illustrate where risk modeling fits in sort of the decision-making process and what groundwork has to be laid in order for the results of modeling to be successfully implemented. Thank you very much for that. I'd like to welcome our next speaker, Joost Bekkers from Deltares. He has a tremendous amount of experience with flood risk assessment for the government of the Netherlands at both the national and subnational levels. So I'm very eager to hear his presentation. So I will bring that up and we will get started.
Thank you, Stuart. Thank you all for coming to the session. The title of my talk is Flood Risk Assessment, and I added to that Coping with Flood Risk, and I'll address that in the second half of the presentation. But I'll start with flood risk assessment. Now, there's a lot of activity on flood risk assessment in Europe at the moment, and quantifying flood risk. And one of the reasons is that the European Commission issued a flood risk directive, and it was endorsed on about 2.5 years ago. And it states that all the EU member states should make, by the end of next year, a preliminary flood risk assessment, and that involves basically identifying which areas in their country are prone to flooding. Then the second phase to be completed 2 years after that is that they should make flood hazard and risk maps, so to quantify the risk in those areas, and then again 2 years later use that information to make plans for flood risk management. Now, in preparation for these flood hazard and risk maps, there has been an exchange program some 2 years ago, and then Deltares was involved in that, and we made an inventory of flood hazard and risk maps that are used at the moment throughout Europe, because of course this is not a new thing. And what we actually did is make a flood atlas, and it will give you many examples of the way people quantify risks in maps. And a few examples are the physical quantities of a flood extent, so the inundation depth, to what area is the flood, which area is flooded, flow velocities, but also vulnerability maps, so which indicate the potential damage or the loss of life. And you can even go a step further to combine vulnerability and hazard, and you arrive at, for instance, insurance premium maps or evacuation maps that support flood risk management. I'll just quickly give you two examples. This is a flood extent map. It's actually a tool called CatNet from Nicole's company. And a second, this shows the flood extent for different return periods of this specific river in the Czech Republic. And the second example is the potential damage in the city of Dresden in Germany. And this is a city that was hit particularly hard in the 2002 Elbe floods. And you can see the red areas where most of the damage is expected. Now the next step in the flood directive is to take adequate and coordinated measures to reduce this flood risk. Now, unfortunately, the directive is not very specific on what are adequate measures. And in fact, in order to determine what are adequate measures, you need to know what is an acceptable level of safety. So we need to have some safety standards first to determine this. Now, in this respect, it's interesting that we are currently doing a project for the Dutch government, and that involves a revision of the flood protection standards in the Netherlands. And here you see a map of the Netherlands, and the dark red areas have a very high safety standard. The flood protection around those areas, so the dikes and embankments, should have a failure probability that must be lower than 1 in 10,000 per year. So basically we don't want floods to happen. And other areas have somewhat lower standards, and that has to do with the severity of the flood in those areas should it occur, or the warning time of a flood before it arrives. So you can take measures before that. Now these standards were set in the 1950s, and in the meantime, of course, the country has developed, the population and the economy have grown, so the government decided that these standards are in need of an update, and they plan to do so next year, and we are supporting them by doing so. And so far we are looking at 3 different perspectives of flood risk, and the first is the economical point of view, and the last 2 are the fatality risks, and I'll go into more details in the next slides. First, the economical point of view. This is basically a cost-benefit analysis. This graph shows that if you try to reduce the probability of a flood or increase the return period, this will mean that you reduce the expected annual damage. But on the other hand, it will cost you more and more in investment in your flood protection system. Now the total cost, of course, is a sum of the two, and it is a function that has a minimum, and then the trick is to find the minimum, and that will be your optimal level of protection, so your optimal safety level. Now this very simple graph, reality is much more complicated, but this is the basic idea. The second perspective is a fatality risk, and we call it the local individual risk, and that's basically the probability of being killed in a flood at a certain location should you be there at the time of the flood. You can calculate this by considering many flood scenarios, and we have a mortality model, so in a certain flood what happens, how many people get killed, where, and we connect that to a probabilistic model, so we calculate the probability of that happening. And what you arrive at is a map, something like this one, and it shows where the risk is highest. Now setting a standard for this type of risk is more or less equivalent to guaranteeing a base level of safety to every inhabitant in this area. Now, how to set a standard for that? One way is to look at a reference, and there's an industrial safety standard for this type of risk, and in the Netherlands, and it says that there should be no urban development within the 10-6 contour. And in this case, that would mean that there should be no houses or urban activities in the red area. And of course, if there is, then some measures should be taken. In case of a flood, that would mean either reducing the probability, so improving your protection system, or other measures, such as improving the efficiency of your warning system or evacuations. Now, the third perspective of fatality risk we looked at is what's called societal risk, and it's basically the probability of an event causing many fatalities. And you can calculate this again considering many flood scenarios and fatalities in these scenarios and the probability of that. And eventually what you end up is a graph like this, and it shows what is the probability of an event occurring that will cause more than 10, 100, 1,000 fatalities in my country. Now, this perspective is typically the government's perspective, because what you're trying to avoid is to have an event causing many fatalities and perhaps social disruption. And as a government, you typically want to avoid that. Now, how to set a standard for that? Again, there is the possibility of looking at an industrial safety standard for this type of risk. And we have one in the Netherlands, and it looks like this. And it's a risk. It includes a risk aversion, because you can see that the probability of having an event having 2 times more fatalities should be 4 times lower. So we want to avoid large numbers of fatalities. Now, obviously, the flood risk does not comply with this industrial risk standard, but then maybe it's not fair to compare a natural hazard to an industrial risk standard. So we might consider applying a tolerance factor, because we know that people tend to accept natural hazards more easily than hazards from human origin. Okay. For example, we drive our car every day, and this is, can be pretty dangerous, but yet we accept the risk because it is partly voluntarily, and we have a certain control over that. Now, if we translate that tolerance to risk to this standard, we arrive at something like this. It's already better, and there are other activities that we accept even more easily. Some people practice dangerous sports, and we have a risk standard like this. Okay. The trick is then to find out what the tolerance to natural hazards such as flood risk is, and that's not easy. We will need social scientists to involve in that. I have a conclusion that the economic point of view is more or less an objective, gives you an objective safety level. The fatality risk is much more subjective. You can compare to other types of risk, but then you need to take into account risk perception and tolerance, and it requires input from engineers, social scientists, policymakers. And for flood risk, you can, of course, consider other measures than pure protection, also early warning, evacuation, and preparedness. Thank you.
Thank you. I appreciate that, and thank you for raising the issues of societal risk, and particularly how to create standards for risk management at a national level. I think those are both important topics. I'd like to welcome our next speaker, Mr. Jorge Sonecki from the Inter-American Development Bank. He's presently involved in an interesting initiative in catastrophe risk management in Peru, so I think that will form part of his presentation. as well as the use of risk indicators that are currently in place at the Inter-American Development Bank.
Good afternoon. Buenas tardes. Konnichiwa. The objective of this presentation is to show how we IDB use the result of the study as a tool for sector dialogue between IDB and the member countries. We know very well that to develop the risk modeling is very difficult, but to use such tools as well as to convince the countries to allocate the budget to reduce the risk is most difficult. In this presentation, we will share our experience of how we use the indicator and what is the outcome from the use of the indicator. And as a case study, this presentation use our experience of the sector dialogue between the government of Peru and the IDB. Oops. Oh. First of all, let me introduce our new IDB's disaster risk management policy approved in February 2007. But because of the limit of time, I will pass this slide. But my message from this slide is we IDB recognize that a proactive stance to reduce disaster risk is most important than post-disaster recovery. So let's see just A1 country programming as our DRM policy. Country programming means we IDB promote the member countries to allocate resources to improve risk reduction at the national level. To achieve this, we consider the following two important points. The first is to know the risk. You don't have a mouse? The first is know the risk. This means IDB supports the estimate the country disaster risk and visualize it to member countries. And the second point is to understanding the risk. This means to visualize the risk and to understanding the risk. But these two processes are totally different. So by the way, what is the risk? This is a very difficult question for us because when we talk risk, we talk about futures, no? So who knows the futures? To forecast the future, no easy. That is the difference between disaster, to evaluate disaster impact as a past event and to estimate the risk as a future event. These two are very different. And the challenge is to visualize future risks for the countries in two ways. Let's see. These are instruments to visualize the risk. The one is a disaster risk management. No, one is an indicator for disaster risk and risk management, and another is a catastrophe risk profile. And this is our four set of indicators: DDI, LDI, BVI, and RMI. And we just focus for this presentation, we just focus for DDI, Disaster Deficit Index. DDI measures the economic loss in terms of contingent resources needed to cover the public sector's loss when a catastrophic event takes place. So how to measure the DDI? The DDI greater than 1 indicates a country's inability to cope with extreme disasters. This means the greater DDI, the greater the financial gaps. And this is a result of the indicators. In 2008, in 2008 of 500 of return period, as you see, most of the countries have the DDI higher than 1. And this means these countries do not have enough resources to cover losses. And this is a result in Peru as a case study. As you see, the DDI is estimated the most of the case every 5 years. In the case of Peru, from 1995 to 2005, it is getting worse, while from 95 to 98, it is getting better, even though DDI 100 is still greater than 1. Now, this slide indicates how we share the result of the indicators with the government of Peru. As you see, we have facilitated many sector dialogues with the government, including Ministry of Finance, Ministry of Housing, INDESI. INDESI is a disaster risk management authority, as well as high-level officials such as minister or vice minister level. Additionally, we organize the press release and technical workshop as well. So we have facilitated many series of events to communicate with the country. And this is a result or outcome from our sector dialogues with the government of Peru. Through the series of sector dialogues, now both IDB and the government of Peru have reached the agreement to allocate the budget to reduce the nation's disaster risk, focused on these 3 points. Now, I would say that this case of Peru is one of the most successful cases. And not all the countries, not all the IDB's member countries does not take into account disaster risk as a priority for country development. Even we facilitate sector dialogues. The point is why the government of Peru is motivated by our study as well as our sector dialogues. In this sense, we can consider the following 5 points. The first is, it is obvious the impact of 2 big earthquakes in Haiti and Chile wake up the government. The second is, indeed, in Peru there is a lot of information, risk information, and this indicator is just one of the series of informations which the government have. So in this case, the country, the Peru, is in the very good condition when the government want to prepare to reduce the risk. The indicator is just one of the technical support tools in this sense. The third is the climate change. The Peru is one of the countries that will have impact from the climate change, and the government are concerned about climate change. And fourth is, the country is still in the clear memory of the damage of the earthquakes which happened in Pisco in August 2007. The last point is regarding leading institutions. In this case, Ministry of Finance for Peru leads the subject very well so that they allocate the budget to reduce the risk. So, yes, that's all. For additional information, this is our site for indicators. And thank you very much.
Thank you very much for sharing a perspective of the IDB as well as discussing what's currently underway in Peru. I think that's an interesting comparison alongside what we've heard so far. I'd like to invite our last speaker, who is Juan Adaya. your programs, say Juan Soriano, who is also here, but it is in fact Juan Adaya who will be speaking about a lot of the risk transfer initiatives that are in place right now in Mexico that have both been developed and are in the process of being extended.
Good evening, everyone. The presentation, the title of this presentation is Design of Financial Mechanisms to Protect the Fonden Patrimony Against Earthquakes, Flood, and Tropical Cyclone. This was also the name of the project we developed in Mexico and we finished just last year. And its objective was, well, as the name says, to generate all the information necessary to implement financial mechanisms that require a technical background and technical information to transfer risk through financial instruments. The first important thing to say when studying disaster in Mexico is that Mexico is a country that is exposed very frequently and sometimes with very high impact to earthquakes and cyclones mostly, and also floods. So there must be something to be done from part of the government. And the task has been done jointly by the Financial Minister and the Interior Minister. The first one, the Financial Minister has just taken the lead in the financial innovation, and it has implemented instruments such as the CAT bond that since 2006 it's been providing help for financial help to Mexico in case of disaster. The Ministry of the Interior provides all the help and coordination in civil protection, and there is a third combined measure to attend disaster, and this is the Fonden. Fonden is a federal fund that receives year to year federal budget just to with the objective of help reconstruction in case of a large impact disaster. When analyzing the information from Fonden, we realized that this is not the best way to face disaster, because this is just a big bag of money that can go very quickly when a disaster occurs, and mainly if it's a large disaster. So we need more efficient ways to deal with risk. And so what we in Mexico did is to think the federal government as an insurance company see the portfolio and analyze and understand the risk that it's facing in order to define retention strategies and risk transfer strategies. So we take advantage of Fonden operation rules, which define precisely which inventory of assets or public assets can receive help from Fonden. And these assets have been mainly concentrated, if we analyze the losses statistics, in four main dependencies, which are SCT, the Communications Department and Transportation, CEP, the Department of Public Administration, Health, SSA, CONAGUA, National Water Commission, and CEDESOL, the Department of Social Development. These are the four main dependencies that have received attention and help from Fonden. And so they were the first one to be considered under this project. This project was organized in four main steps, and these were very logical. First, to construct a large database that contains enough information about location, about structural characteristics, and about economic values or replacement values, in order to have a database that can provide proper risk estimates. The second step was the physical modeling, and the third step, parameterization. And these two were very intensive in engineering and scientific work. Here we took advantage of the institutes of Mexico that have studied this risk for years, and they develop models for each of the menaces we were considering, and also make the necessary exercises to parameterize the risk in order to also consider financial instruments that require parameterization, such as parametric insurance, or catastrophic risk with trigger elements. And finally, our last step was the main objective, which is the financial modeling. And the idea of the last step is, once we have measured the risk of the assets that Mexico has and face each of the risks, we need to distribute the risk, and with these risk measures, define the proper retention levels for each of the dependencies, define proper layers for insurance, proper layers that the reinsurance market may take, and also to study layers that could be feasible to implement financial instruments such as catastrophic bonds. So something very important to say is that we were very lucky in the database gathering and construction, because we have the fortune that many of the dependencies that we were considering have just finished each of them proper projects in which they build their inventory, very extensive inventory, geo-reference all of the databases that we study. Even the highway infrastructure was just finishing a work where they geo-reference the whole federal network, and we have reference for every 10 meters of the federal highway, and so we can get very, very precise estimates of the database. And when we took advantage of all this information, gather it together and get our database for developing risk. We also consider very important to mention that this database has these three levels I just mentioned. That was to give priority to the elements of location, so that we have a geocoded database, elements of structural characteristics, so that we could model each of the elements of the inventory to get vulnerability functions and proper estimate losses. And finally, replacement values that could give us estimates of losses that could make it feasible to be transferred to international and national insurance market. Of course, we had some very special cases, for example, where information were not enough. One of the very tough tasks in this project was the housing for the poor, that is defined in the Fonden rules, and we have to consider it in the project. But we could get approximate information and try to build the missing values that we had. For example, we use the central location unit, which is called a head. It's a small partition of the territory, which gives us the identification of each of the location of the houses. We use sensor data to estimate the characteristics of each of the houses and the percentage of poor that were in each of these partitions, in order to define a typical building models of houses. We have at least 5 type of structural for houses of the poor, and a vulnerability function associated with each of these modeled houses, so that we could approximate the losses derived from the housing. After gathering the information for database, it was also implemented a series of validating exercises. One of them was referring to the location. We use a sample exercise just to visit some of the locations of the database, just to verify that if the georeference was in proper limits, if the characteristics assumed in the modeling of each structural type correspond to each of the houses we were visiting, and we were verifying this information in all the database. We visit houses, for example. We have some pictures, highways, hospitals, houses for the poor of different types, so that we could verify if the assumptions made were pointed accurately. So in all this, of course, and also recognizing the effort done by other institutions, we rely on UNAM, the University of Mexico, which provide the help in all the scientific and engineering front. Here they help us very much in determining the methods for gathering the assets of the inventory, all the models built to each of the hazards that we consider, and also the methods to parameterize the risk with the menaces we were studying. And finally, at the end, we were, to feel more comfortable with the work we were doing, we asked for the help of a third expert that could give us the opinion for the work that we were doing, and we searched for the help of RMS, the Risk Management Solutions Enterprise, that has done many exercises like this, and he expressed favorably to our database and to the exercise. Very important for us, they were saying this exercise was suitable to provide reliable estimations of risks for the assets we were considering in the database. I have just 1 minute, so I will jump very fast to the rest. Once we have determined the size of the risk and how it looks for each of the dependencies we studied, we try to cut the risk and share the proper layers to each of the agents that can participate in this. Very important for us was to invite the private sector just with these elements of information so that they can participate, because sometimes that is the problem with the financial formal sector, that they don't have the information necessary to make their proper estimates. So we, with these informations, can define the layer of protection we need and give the insurance sector the information they require. Just as a final remark, this is just for us the first step. We are just doing the continuation of all these works. We can share with you in a first step that we have already using the results of this project to redefine or improve the insurance scheme that some of the dependencies have. This about just 2 weeks ago, the dependency of public education just got their coverture of insurance, and it incorporates the layer that we proposed with this study so that we could manage more properly the risk of the education sector. We also are using this information now to make a coverture strategy for the highway system and bridges, and we are also starting to make a second part of this project that will increase the original objectives, including more risk, including more infrastructure, and try to make this project a little bit larger. Okay, thank you.
Thank you. I'd like to ask everyone to join me in giving a round of applause to all of our panelists. And I'd like to ask if our panelists would have a seat over here. We've got some questions, and with the remaining time, we'll take the questions. Okay, the first question is for Juan, which is, I think, to what extent is the CAPRA initiative of the World Bank helping to support the work you mentioned, either now or in the future?
I understand the question refers to how it could help in this project.
I think the question is, to what extent is it helping?
We didn't use CAPRA directly. UNAM developed all the models and risk estimates we used, but we understand that most of the personnel that is working in CAPRA is also working at UNAM, Mexico University. So we can assume that most of the human capital is in both projects.
Thank you. And then a question for the group and whoever's feeling bold enough to take a stab at it. Isn't there the possibility that risk transfer tools could become a perverse way to neglect other parts of risk management, particularly by believing that once insured, the problem is solved? Anybody want to make any comments about that?
That's perfectly true, and this is why I think it's very important to put that into perspective and really to to emphasize that risk financing is not risk reduction, it's risk transfer. So someone at the end will have still to bear the risk. Now, it's not, and again, it's a dialogue we have with many of our counterparts, it's not one or the other. It should be one and the other, meaning that risk reduction is quite efficient for some risks, but up to a certain point. You cannot build dams up to a point there you don't have any risk. You still have a kind of residual risk. And this is where risk transfer may make sense. So again, we're going back to this concept of cost-benefit analysis, where up to a certain point, then risk financing and risk transfer instruments, insurance and other instruments may make sense. But again, yes, definitely the first step is to focus on disaster risk reduction. The second point, quickly if I may, is that again, using some risk financing tools can also sensitize you about the cost of risk, because one of the beauty of risk financing is that you're going to price the risk. So again, it gives you a sense of the cost of risk you're facing, and then you may want then to come back to balance that with the cost of risk reduction. So they are, if it's well managed, then it's not a perverse way, but it's in fact they're complementing each other.
Just in regard of the same, when a government takes a project large enough to estimate risk of the whole country, it will realize that the information it has is quite a lot. So it is inevitably also to get to the next steps, in the sense that prevention information is good enough to make prevention plans, territorial planning, risk maps that may promote public policy in the direction of prevention, and it's almost a natural step to go beyond and take all this information into the civil protection scheme, so that we could improve all the strategies that are already in place, and combine it with the guiding line of risk, because you could have the risk estimate, and with that take it as a pointer to all the other actions that you must take in civil protection and prevention and territorial planning, etc.
Nikhil, you had one comment? Yeah.
That's better. I think the other comment is, I mean, we make, the discussions today were fairly complex at a high level. You saw a lot of talk about, large data sets, parametric insurance, cat bonds. In the end, for me, it's also a very personal decision. I often relate when I talk to our clients about the decisions we make at home. I look at my own household, and I'm phenomenally obsessed about risk prevention. I'm constantly going around locking my doors and windows. On the other hand, my wife doesn't lock anything up. So, in the end, these decisions are also ones that countries, just as individuals, have to make on their own, about what is the risk we want to bear, what are the ramifications of bearing that risk, and of course, what are the alternatives we have to finance it when things go bad, because they inevitably do.
Okay, thank you. We've got a very interesting, timely question, which is, given the current crisis in the Gulf of Mexico due to the Deep Horizon oil spill, should ecosystem risk be assessed and managed?
I can comment on that. That's one of the things that are also in the European Flood Risk Directive that I didn't mention. That there are also the directive specifies that you have to assess risk, and of course economic risk and fatality risk, but they also mention environmental risk and even possible damage to a cultural heritage. So there are other types of damage or consequences that you conclude in your risk indicators.
And while you've got the mic, Joyce, there's another question that's related to that, which is touching on societal risk and really saying that social risk is more than just fatalities. It is cultural displacement, changes in livelihood, demographic shifts, etc. How can social risk be more effectively captured in quantification or the modeling of catastrophic impacts?
Oh, I'm not completely sure if I understand what you mean by social risk. The societal risk, as I defined it, is very, very much specified. It has only got to do with fatalities, so people getting killed, and the number of that. Of course, there are other types of social effects on the common memory of society, people having traumas or things like that, and I'm not sure if that is what they refer to as social risk.
Maybe this is the case, for example, in the Central America countries when the earthquake of Managua struck in 1972. They began a migration of Nicaraguans to Costa Rica and the rest of the Central America countries. In El Salvador, it's the same. When El Salvador was hit by an earthquake or a cyclone, a lot of persons have to emigrate outside of the country. We was talking with a Salvadorian partner, and he told me that a high proportion of persons from Salvadorians are outside of the country because they have to move because of the natural catastrophe. It's not just ecological damage. It's a matter of survival, at least for our countries. That is quite important to understand the risk and to try to handle and to have a mitigation and all the different risk management techniques in place. That's it.
It seems like that would, just to follow up, it seems like that creates an issue not only for the affected country, but for the countries that would be absorbing that population and that migration as well. I don't know if anybody has any additional comments about that question. I think it's kind of interesting. If not, then we can address some other topics. Nikhil?
Maybe only one. I think one of the reasons we also have these forums is to think about risk beyond our national borders. A classic case is, the earthquake in Chile, at least for 12 to 24 hours later. Potentially one of the places that had the most exposure was the island state of Hawaii. When we think about risk only within our borders, we ignore the contingent liabilities we bear from other countries and what we essentially also contribute to other countries' risk profiles.
Okay, great. I've got one question for Jose Angel, which is the following. Institutional government buildings represent a risk that is different from private property because presumably these have been designed and or supervised by state-employed engineers. What are the instruments in use in Costa Rica to ensure the quality of these state-owned buildings?
The construction of buildings in Costa Rica, first of all, is, as I said, we have a lot of laws and norms to regulate everything. So, for example, the seismic code in Costa Rica was the first implemented maybe 25, 30 years ago, and has been updated at least 4 or 5 times. Okay, and also we have an engineering college, a profession, which is each engineer is responsible for the construction of the house, of building, or whatever. And even if the engineer made a mistake or is lazy with having a proper supervision of the construction of the building, the engineer can be banned from the profession. So this procedure is the same for public or private building. This is a law. It applies equally to everybody. I don't know if.
Okay. All right. I'll close with one final question since we're coming up against the end of the session. There's some questions that we didn't get to, so I please encourage you to come up after the session ends formally and approach the panelists individually. And the last question is, in this and in other sessions, the term economic losses has been used a lot, but often it seems to mean no more than the value of a certain capital stock. The impact of a disaster as an economic shock can be much deeper than the capital stock losses. Is it possible to anticipate true economic loss, including productivity, education, health, infrastructure, commerce, etc., and a follow-up, can we anticipate a GDP growth shock for existence? I suppose the implication is following a disaster, will there be a spike in GDP?
Maybe let me start, and others may have some comments. I think it's a very true question, and this is definitely something where sometimes we struggle how we define a loss. Sometimes we intentionally use the concept of loss and damage. My understanding for most of the work done on the risk modeling side is mainly focusing on damage. Now it's a stock. Now how you're going to transform that in terms of flow is a true economic issue. Then in addition to that, as we said, you have some losses, but you may have some losses, additional expenditures when there is a disaster, but also you have some loss of revenues, for example, future revenues. Again, at the government level, loss of taxes after a major event. So again, how are you going to capture that? There have been some attempts to link that to some economic models, either input-output models or to some general equilibrium models. I think this is still kind of way of research. Now, for example, the problem we're trying to address when we talk with governments at the World Bank is to make sure that we clearly decompose damage, kind of physical damage, and economic losses, or indirect economic losses linked to flows, which are something much more difficult to capture, and also depend on the kind of time horizon you have. Do you want to capture the kind of losses over 10 years after a major disaster? You want just to capture losses over 1 year? So again, I think it's definitely a subject for more research in the future.
Yes, I think that this kind of losses, they are we use in insurance language a consequential losses. Just seeing at a macro level. That's it. So, as long as we can minimize the damage, the physical cost, we are going also to hopefully to reduce also the consequential damage produced by the devastation of the loss of buildings and schools and hospitals and so on. So it is quite difficult, per se difficult to quantify for catastrophe the losses, the physical losses, and the consequential losses is even more difficult. But that is just my opinion.
Yes, I think that is why the Dutch government is also now considering fatalities separate from economic losses, because that is something that's so obvious, but very hard on the other hand to express in terms of money. So they decided to make that a separate indicator and set separate standards for that type of risk. And obviously you could do the same thing for other types of consequences, but then it gets more difficult to calculate probably.
I think from the insurance market perspective, you also, if you look at the most complex commercial insurance policies, you get a sense of the trends that will then obviously reverberate in the work that we do here. And following September 11th, a lot of the policies began getting more complex on their, as you pointed out, consequential damage. And if you look at some of the more sophisticated policies now, they include coverage essentially for the interest rate changes that a major corporation will have in financing its, let's say, deficit following an insurance event. So you really see a movement away from the traditional capital stock kind of insurance loss to really complex forms of trying to pick up financial loss that's a consequence of an insurance type event, be it a hurricane or that kind of disaster.
Okay, I'd like to thank everybody again for their participation. I invite everyone here to please join the discussion group if you haven't already. If you can take the time to join some of the discussions on the website, that would be much appreciated. And thank you for being here and for your attention and for your questions. And thank you again to our panelists.